Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, well, here we are Friday, and we get to chat. I always look forward to it.
Bob, we'll start off the show with a question from our good friend Frank in Belgium. Frank asks, whenever the market declines a mere 5 to 10%, central banks and market pundits panic and think another crash is here 2 days down. The market and everybody is nervous. In the meantime, Jerome Powell has his finger on the buy trigger. Christine Lagarde, who's now the new boss of the European Central Bank, dreams about negative interest rates, and the Bank of Japan keeps on buying bonds and stocks with the ambition to become the mother of all hedge funds. Is it possible, Bob, that central banks are still firmly in control and that they have one more credible trick up their sleeves to evade a credit contraction this fall? Are they really to the point where the market does not take it anymore?
Yeah, Frank, that's a comprehensive view on the market with the question, and the key thing is that can the central bankers keep the party going? And for that, I would say we want to go back to the formation of the Federal Reserve, which is now the senior central bank, and the promoters behind it knew that when you had a financial setback, it would be followed by a recession. So then their theme was that with the Federal Reserve as the lender of last resort, you would prevent financial setbacks and bail out a bank and everything would be fine, and then there was no need to have recessions. So that's the theory. But if you look at the National Bureau of Economic Research, which is the sort of semi-official body that keeps track of booms and recessions, there's been 18 recessions since the Fed was formed. So any practical person would say, yeah, it's attractive theory, but it doesn't work. But the guys have got the power there, and they will continue to impose their crank ideas, and they really are crank ideas. And also, in the last decade, is the most reckless of all central bankers, as Frank points out. The negative interest rates is an indication of extreme recklessness. And then I like the line about the Bank of Japan becoming the biggest hedge fund ever. But it's the same tools that they've had. At one time, when I first came into the business, there was a sense that the Bank of Canada or the Federal Reserve System in the States had privileged data and privileged knowledge, and then that gave them special powers. But it's never worked. And nowadays, with the assembly and distribution of data, the Fed's just not there. So what we want to do is realize that the characteristics of a great financial speculation have been the same in any century. And the first one started was the South Sea Bubble in 1720. And participants then had no template for such a bubble, but created a bubble. And then the key features of each bubble have been repeated each time, with, I would say, each new set of participants not having studied the previous. So it's a voluntary greed thing, and we know that the central banks have never, ever prevented a crash when the bubble has reached its greatest extent. So then the question is, how do you measure? And well, one is that we rely on is the Standard & Poor's relative to GDP, and also relative to the average wage in the States. And the S&P has been higher, well, very much higher than reached at the peak in 2007, and even higher than in the dot-com bubble craze of 2000. So you have these exceptional high valuations. At times you've had terrific momentum, and at the same time you've had one-way sentiment, very bullish. So one waits and see how all this works out. While the central banks can temporarily lower interest rates at the short end, and for some reason or other in Europe, it's gone out to the 10-year, where you have this absurdity of negative nominal interest rates. But the central bankers cannot control the yield curve, which is the difference in interest rates from the long end to the short end. And it has had its first step in reversing to the direction that we would call a contraction. And then the other one, which they have no control over at all, is the credit spreads, which is the difference between high-grade and low-grade bonds. And they have been partying for a long time here, but in the last few months they ran out of energy and are kind of rolling over. But that's on the price of junk bonds. But when you compare it to treasuries, you have had a terrific narrowing of credit spreads, which reflects credit confidence. And then over the last 2 months, you've had the market trying to reverse to widening credit spreads. So in 2007, when we were watching this, it was the first breakout in reversing the trend was a heads up, and then the killer one was the second breakout, and the second breakout occurred a week ago. So this is kind of fresh stuff, and spreads have continued to widen. So just looking at the spreads, you could say that this is anticipating a contraction, and it will be confirmed when the yield curve gets reversed. But you've had this tremendous disturbance from last week when the Fed cut its administered rates by 1/4 point. And many were not prepared for this, so this is why you had this absolutely brutal short covering squeeze in the bond future. So here we have it. Huge speculation, and the credit spreads and yield curve, other things like the price of gold and the U.S. currency, doing similar things to what happened at the culmination of previous great bubbles. So the next step, Jim, is to say, okay, you've had 5 previous great bubbles, and when did they suffer their worst? Well, each suffered a lengthy bear market that changed the world, but each of them went from things okay in the summer to a crash in the fall. So, and we've had things very good until mid-year, which was our objective. And we can talk about sunshine and twilight after the break.
We'll have more from Bob Hoye right after this.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Welcome back. We're speaking with Bob Hoye. Bob, President Trump has said he wants a 1% cut by the Fed right now, today. If they could do it, should they, could they, and would that make any difference in the long run?
Well, no, it wouldn't. And I think that, a year or so ago when Trump first started criticizing the Fed, I thought, he shouldn't meddle with the Fed. And then afterwards, when he was calling for a decline in short rates, I thought that's good, because what it is putting the responsibility in the hands of the Fed, or the blame in case something goes wrong. But the Trump at the moment is reflecting standard understanding of the financial markets. Even one of the, I think it was, I forget which chapter of the Fed it was, but anyways, the chair of whichever Fed it was a while ago said they wanted to lower the Fed funds rate in order to prompt inflation. But throughout commercial history, as long as you had stock markets, which in England goes back to the, about 1680, when you had enough companies listed and enough participants trading to call it a stock market. At any rate, short-dated interest rates go up in the boom and down in the contraction. And the other irony is that you get the fastest declines in short-dated interest rates during the worst part of the bear market. Just look at what happened after 2007. So I think Trump is right to criticize the Fed, but this one calling for a much bigger cut as if it would do something is a bit off the mark. He's talking rather conventional wisdom there. So I think we just have to look at this and realize that the change in the credit spreads is really ringing a bell now, but it'll need a few more bells to be ringing before you get the full warning. Industrial commodities have been weak. Perhaps crude oil got a little weaker than it need be and maybe could be firm over the next few weeks, but we know that the base metals have a tendency to set seasonal lows at around November, December. And we know that crude oil has a tendency to set seasonal lows sort of December, January kind of window. And we know that lumber can set a seasonal low in October, and we know that the stock market goes up and down with industrial commodities. So, Jim, it's looking a little precarious out there. One of the other things that you want to find things that are common to each of the great financial manias, and one has been to take the rate of interest, long-dated rates in the senior currency, and adjust it for consumer price inflation, and then you end up with what they call real rate interest rates. So on three of the great bubbles, well, let's put it this way, on all of the great bubbles, real long-dated interest rates went down with the boom. Money got cheap. And then it went up with the bust. So and in 3 examples, real long interest rates went to negative. And then it turns. So, and the increase in real long interest rates can be severe. Like a typical one was about 12 percentage points, which is huge, but I've always taken it as Mother Nature's way of correcting the recklessness of a new financial era. So now that's one. So real long interest rates have come down with this boom, and we're watching for them to turn up. They're still declining. Then the other one is that you take the price of gold in senior currency terms and deflate it by the CPI, and you get gold's real price. And it goes down in each of the great bubbles and then turns up. So the way we look at it now, the real price of gold was very high in 2011 when all that speculation was on, and then it has literally had a long crash. But let's say the last year and a half, it appears to be bottoming as the financial mania is blowing out, which is the way it should be. So then once the financial mania rolls over and dies, then the real price of gold would go up, and this is then what in the past has created a long bull market in a post-bubble contraction. The 1930s was a fabulous market for gold stocks, and yet there was the real price had gone up a lot. So that's what we got ahead of us, Jim, is a lengthy bull market for the gold mining industry, and it's one of the few things that you can forecast in a post-bubble contraction. So just to sum this up, real long interest rates have declined, which is the way it works, and the real price of gold has declined, which is also one of the features of a great financial mania. And so what we're looking for here now on real is the real long interest rates to turn up. That's not happening yet. But gold is, it's working on it, and it won't take much for the real price to break out. But then you don't want to buy the stocks because they're rather high now. And what sets up the long bull market for gold's real price is a financial contraction, which could become evident this fall.
We'll have more with Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, shadow banking has caused India to go into a tailspin. What about China, where shadow banking is also huge?
Oh, yeah. You know, I'm glad you brought this one up because for the last month in reading the financial media about China and devaluing its currency and stuff like that, and I thought, oh, this is policy making. And then all of a sudden it comes into view that, no, this is the weakening Chinese currency is a sign yet of contraction hitting them. They're running out of reserves. So let's go back into earlier in the year when Argentina was discovered to be kind of running out of reserves, so their currency took a hit and their short-term rates went up. And then it was Turkey. So I'd always called these lesser exchanges. And we all know from history that when you have a financial problem, when there has been a boom, when you have a financial problem in a lesser country, it eventually feeds into the senior financial markets. And I consider London and New York the senior financial markets. So then a little later on, maybe just 5 or 6 weeks ago, then they were getting the same stories out of India. Now, India is such a huge country that you can't call that a lesser market. So then I said outlying exchanges. And so you then had this hitting India, as that headline was, that a shadow banking crisis sent India into a tailspin. And then this is now what's working over China. So it is a classic problem whereby outlying exchanges discover the loss of liquidity first, and then it feeds into the senior financial exchanges, as I've said, London and New York. So, and then again, you go back to history. Now, when is a liquidity crisis likely to be discovered? Typically in the fall. So, the big picture on this is absolutely fascinating. And here was a headline from Bloomberg: U.S.-China slide into policy vortex with no easy escape. But this is misleading. They're talking about that, yes, some trade things can be worked out. And Trump, I've agreed with that he has been attempting to reduce the iniquities in trade agreements that were always more beneficial to the outside country than to the U.S. So that was one thing that was constructive for the U.S. to do. But then the problem is now that if we go into a financial contraction, then unemployment will rise, and then you've got politicians who will be pressured to do something about unemployment, and the typical thing has been to bring protectionist measures in. And I think it'll happen. There was a huge bubble in 1825. That was a really big one. And it crashed, and the contraction was pretty harsh to the U.S. And they came out with what was called in real time. I mean, it was so bad that it was called the tariff of abominations. So it gets really ugly on tariffs and things like that. So it's nice to know how these things work. And while they're unpleasant in prospect, one might as well know that there are great dislocations coming, and it would be in the financial markets. They've been calling this the everything bubble, which is what happens in a great classic bubble. Everything gets bubbled, and then everything gets unbubbled. So that's our phrase for the week. Everything's going to get unbubbled. How about that one, Jim?
Bob, fast food sales at Tim Hortons have fallen for their lunch crowd, and there are fewer orders for Ferraris. Are they connected?
That's a good question. Yeah, you might say that fast food and fast Ferraris are both declining. Yeah, it's both ends of the spectrum. It's lunchtime at Tim's, and it's on the other is at the sales floor of high-end Ferraris. So, and you know, the Ferraris I guess cost a couple $100,000 or $250,000. And what's a cup of coffee at Hortons these days? So it's from low end to big end, and it's important.
Well, what does it tell us?
Everybody's overextended. So people at their coffees or going in for their lunch break at Tim's are cutting back. They're having maybe lunch at home, which is cheaper than going out. And then also the guys who are buying Ferraris for their 18-year-old sons, perhaps getting a little wiser. So, I don't know. We'll see how it goes.
Yeah, if you want your kid to live a little longer, don't buy him a Ferrari.
Well, 20 years ago, here in Vancouver, where there's a tremendous Asian influx with lots of money, and the fad was that you had to have the hot Subaru WRX. So these kids were getting their driver's license and then suddenly into a very hot car. And now into the Ferraris and Lamborghinis.
And
I know a guy who has a high-end car dealership here, and he points out that Vancouver market for these high-end, high-performance cars is, at times, first in all of North America. So, it's impressive to see it, and it's also fun to see the sales for luncheon items at Tim Hortons declining. At the same time, sales for high-end Ferraris are declining. So that's the whole spectrum, isn't it?
Yeah, I recall parking next to a lime green Lamborghini with new driver stickers on it.
Yep.
Yes, it's a Vancouver phenomena. Bob, thank you so much for chatting with us.
Always good, Jim, to be with you, and we look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. You can be like Frank from Belgium. You can send Bob questions to info@howstreet.com. Our Twitter handle is @HowStreet. Our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.